Hello, welcome back again. I hope you're having an awesome weekend. Pretty hot these days, at least where I am. Now, in this video, we're going to be taking a look at Amazon and Apple. We're going to discover which one of the two companies makes more sense to buy right now, because both have been beaten down quite some. If you take a look at the 3 months chart here for Amazon, you will see that it used to be at around 168. This is adjusted for the split, by the way. Everything in the tool automatically gets adjusted for the recent split. And so you are noticing that the prices are, even if you take it 5 years back, pretty much adjusted for the recent splits. And the same thing happens with the outstanding shares here, again adjusted for the recent split. Now, if you take a look at the 3 month chart again, it's been going down quite a lot from 170 almost pretty much here to 116, which it is right now. It actually used to be even lower. At some point it was near 103 here, which is absolutely insane. But the question to ask is, was it at any point cheap enough to buy? Or maybe it is cheap enough to buy right now. This is what we're going to examine. And also compare it to Apple, because Amazon and Apple are both companies that I would love to own in my portfolio. I don't own them right now. I'm expecting for a better price. But maybe that time has come. And this is what we're going to be examining in this exact video. Okay, so the P ratio of the company is sitting at 56. That's a little bit expensive. You normally want it to be maybe around 25, 30 if we're talking about a tech company that's increasing its revenue, profit, net income. It basically has great growth. You will see that Amazon, for example, has amazing net income growth here. But 56 may be a little bit high, but it's not the end of the end all, basically. We have to examine it in more detail and see whether this high value is still a green light for us. But the price to free cash flow, you may be saying that this is negative, so that's a problem, right? Well, yeah, it's typically a problem, but in this case, there's a reason for this one, and it has to do with capital expenditures, which we're going to examine a little bit later. Same thing happens with the total liability to free cash flow here. It really gets affected by that. And of course, the growth over here. Now, the thing is, Amazon doesn't seem to be having a lot of debt here, and the return on equity is still 17%. The net income margins are rather low, but that's, I guess, rather typical for the business that they're having. And what we do want to examine next is we kind of need to take a little bit of a look at what is going on with the statements here. Why is this happening here, especially with the free cash flow? Now, this company is a revenue machine. Take a look at this, 178 billion to 460, almost 70 billion. This is absolutely tremendous growth in terms of revenue for such a large company. It's amazing to even think that they could be doing something of that sort. It's amazing. And the net income, again, from 3 billion to 33 billion, that's, outrageous. It's insane growth. So the balance sheet of the company is, as you'll see here, total equity is 27, 28 almost billion to 138. Another one which is doing absolutely amazing here. Noting is the total liabilities, 282 billion. That's a lot, of course. And if you take a look at the cash flow statement, you will see that the pretty much average free cash flow that the company has been generating, you can kind of see it here. It points you to 11 billion, but this is because of last year's negative one. It's about 20 for the most part if you exclude this year. Now, why is this negative and what is happening here? If you take a look at the net income, it has been increasing tremendously as we examined earlier, and if we adjust it for the non-cash expenses, we are getting 38, 66 and 46 billion here. Now, what is happening and why are we getting these values? Why this difference? Of course, you will see here that we had another non-cash item here, which was a one-time cash expense, very large, that actually affected this significantly. And there was a change in working capital as well. This is typically because we are spending money, for example, to buy new inventory, for example. Now, and working capital is basically the difference between the current assets minus the current liabilities. So this is how this gets introduced here to the operating activities cash flow. The cash from investing activities here, this is very important because you will see that typically Amazon used to have like 12, 13, 16 billion in terms of capital expenditures, and then it jumped to 1461 over here. And this is happening because Amazon is actually investing in themselves. I don't have much trouble with that. This is absolutely fine. Companies who invest in themselves, they can actually keep growing very nicely as long as they take the correct steps. And Amazon is a company that has proven that they can take the correct steps in the past. And you will see here that basically their investing activities has been negative, which makes a ton of sense. But financing activities has been slightly positive here because of some extra debt. Now, the thing is, the free cash flow has been falling tremendously again because of the capital expenditures here, like 61 billion, and the company was making 46 in operating activities cash flow. And this is why this is in the negative, and you are getting this negative cash flow sentiment pretty much. But that's not necessarily bad. What is important to note, though, is that this value would typically be maybe about 30 billion if we didn't have so many capital expenditures. And it's worth noting, if we take it back to the balance sheet, that the company had 82 billion in terms of total liabilities. That's many times its free cash flow. That's a very high multiple in terms of the year. It's like what, maybe 8 or something of that sort. I could be mistaken right now because I'm actually calculating it from off the top of my head, but it's not tremendously high, so it can definitely be acceptable, especially for a company that keeps growing that much. It seems like they are very much handling their their situation and their operations very gracefully so far. Now the thing is, the company is amazing. I mean, we know that it's been growing tremendously. Everything is green here, again, apart from the cash flow. That doesn't affect our tool here. It doesn't affect it at all. But what are we doing in terms of revenue growth is a question. The company has been growing tremendously. We cannot go with these insane numbers, of course. We need to go lower, and we need to be much, much more conservative here. I'm going to go maybe 10, 12, and 14, and maybe that is even a little bit too gracious here. So net income margin, maybe a little bit too generous, pretty much. The net income margin here, 4, 5, 7. I'm gonna go in between. I think I'm gonna use basically 4, 5, and 7 here. And the free cash flow margin, excluding this one, is sitting near maybe 120, 130. This is relatively high, actually, based on what the company has been doing in the previous years. So we're going to go a little bit higher, so 100, 110, and 120. And the annual return is going to be 13%, is what we typically use, and we're going to use the same for Apple too. And we hit calculate here, you will see that we are kind of getting there just for our high estimates, though. And our high estimates are not too high. I mean, they could definitely happen, but they may be a little bit aggressive, especially in terms of the free cash flow margin, although the company has been achieving that and even more, frankly speaking. This year basically perplexes things, but overall they have been achieving this kind of high free cash flow margins compared to the net income. But it's still looking a little bit expensive. I would probably want to get it near maybe $80 or something of that sort, if that would be possible. Maybe 90 if I was feeling too adventurous. And again, because I'm having a company that could be growing tremendously through the years, maybe that. Company has an amazing balance sheet. They're doing great in terms of revenue. I could potentially pay a little bit of a multiple. It would be a little bit of a stretch, but maybe, just maybe, it could be a decent price, near maybe 85, 90, maybe. I definitely have to think about it again. Now, let's take it to Apple. We're going to switch it up a little bit, and we're going to go to Apple now, see what we can actually get out of this company. And we're going to visit the stock analysis tool first, before we do our stock evaluation stuff. You will see that the company has been suffering as well, minus 22%. This is less than Amazon, like significantly less. It hasn't dropped that much, but it's been down to 151 right now. Now, if we take a look at the P/E ratio, 23, this is much, much better than Amazon, as you can understand. And now the price to free cash flow is positive, although a little bit high. Outstanding shares at 16 billion, but remember that Apple is actually buying back shares like crazy. You can kind of see it here already, and they keep doing that. This is something that I absolutely love from my companies. One of the core reasons why I bought Google back, because they're doing the same thing, and one of the core reasons as well that why I like Apple so much as well. This company is different. It's a different story. They are not spending too much in terms of free cash flow, in terms of capital expenditures. This is why you'll see that they are still generating tons of free cash flow, very easily paying for total liabilities, and they keep growing tremendously. Now, this company is doing something different, which we have talked about. It's actually getting a lot of debt and decreasing equity on purpose. And they are doing that to increase the return on equity. This is a very, very well-known sort of like accounting trick. And it also helps the company because they were basically getting free debt because interest rates were super low. And it was a good opportunity for them to get some extra leverage just by getting some debt, because it was basically free for them. And I mean, you can use this leverage to make tons of money. So why not do that as a company of that sort, which is very, very safe in terms of financials. A very good choice, which I definitely like myself. Net income that is much better than margins here from Amazon. That's very important as well. And the company is also paying a little bit of a dividend, which is very safe. We have talked about it in the past. And again, we can use our dividends module here to discover the finer details. 0.65 is the current effective yield, and you can kind of see how it's been growing through the years. But okay, let's take a look at the stock evaluation tool. Apologies. Well, let's take a look at the income statement first. Again, a company that has been growing their revenue tremendously, 229 to 365 here, and 48 billion in net income to 94, doubling that pretty much effectively. And it's the balance sheet that may seem a little bit problematic, but again, there is a reason for this. And as we mentioned, it is all about the debt that the company is accruing, pretty much. They are doing it on purpose. They are getting extra debt on purpose just because they are using it for leverage. And you can kind of see it if you take a look at the liabilities that the company has that keep increasing quite a lot compared to what they are doing in terms of their assets. But again, this is something that is expected, and the company is also buying back a lot of shares, a ton of shares really, and so you could expect their assets to go down, their equity basically to go down on the assets. And you will see that the total debt has been increasing as well, and the total liability is increasing pretty much tremendously too. And as a reason for this one, as a reason of what has been happening, total equity has been going down. But again, this is a calculated move. It doesn't worry me in the slightest, really. And what are we doing here in terms of the company's revenue growth? They have been growing the revenue last year tremendously, but we don't expect this to happen in perpetuity, of course. So we're going to go lower because typically they have been doing significantly less. And so I'm going to use the averages. I'm going to go maybe 8, 10, and 12, maybe a little bit less than the averages. Net income margins are very steady here. And 22, 23, 24. Free cash flow margins, again, very steady for the company, 100, maybe 105 and 110, and an annual return of 13%, similar with Amazon because we want to compare them directly. We hit calculate here and we are seeing that we are also far, but you will notice that the price difference, pretty much the spread, is almost similar to between Apple and Amazon. So remember that with Amazon we were also kind of close to the high estimates here, and the same thing, the same story with Apple. So both of these companies, if they fall a little bit, like Apple right now, 120 maybe, it will also be a great opportunity. Now, which one of the two I would personally prefer? I like both, but not for buying right now. These are tremendous companies. I want them at better prices if possible, and I'm willing to wait. Maybe it will happen, maybe not, but I'm willing to wait for my opportunity. Now, if I had to buy one of the two, which one I would buy necessarily, like if I really had to buy one of the two, that would be Apple right now because it seems to be slightly cheaper than Amazon. But both companies are great, absolutely tremendous, and growing well. But I do like cheap companies because I'm getting a margin of safety, and they are both great in terms of how they are growing, what they are doing financially. Love what I'm seeing with both. So I think I would probably get into Apple right now if I really had to, but if I didn't have to, and I don't really, I would probably avoid both for now and just wait for a better opportunity. But I wanted to make the video just to compare the two because I really would like to have both in my portfolio eventually. Hope I can get the chance to do so. But let me know, do you own any of the two? Do you prefer one or the other? Which one is best for you? Which one would you prefer? Or which one are you holding already? Leave a comment in the comments below and let me know, guys. And thank you for watching this one. Remember to leave a like as well, that helps a lot. And subscribe if you're not a subscriber already. I'll see you in the next one. Have an awesome rest of your weekend. Bye-bye.